Today we are going to talk about the MACD trading indicator, and this is not going to be a regular indicator video, but the MACD is actually a very beautiful tool to analyze the price action in a very unique way, because the MACD provides information about the momentum, the speed of price, and also the trend strength, all in a very fascinating way. And I've divided the video into 4 parts. First, it's about understanding the MACD and the different components. Then we're going to take a look at how to use the MACD. In step 3, we're going to build a trading strategy with it. And at step 4, I provide some final thoughts about the indicator. So let's get into today's video. So the MACD has different components when you throw it onto your charts, and let's take a look at them step by step. The first one is the so-called MACD line, and generally after you apply the MACD to your charts, you will have a histogram and then also you have the MACD line. And the MACD line is nothing but the difference between the 12-period EMA and the 26-period EMA. So here on the charts I added the 12-period and the 26-period EMA. It's the blue and the black line. Those are the two moving averages. And the MACD line is nothing but the difference. So you subtract one from the other. And right away what you see is when the two moving averages on your charts cross, that's when the MACD line also crosses the zero line. So the MACD line is a very interesting tool, and it resembles something like a moving average crossover signal. So when the MACD line is below zero, it shows you that the short-term moving average, which is the 12-period here in blue, is below the 26, the longer-term EMA. And this generally is signaling more of a bearish scenario, whereas if the MACD line is above zero, it means that the 12-period EMA is above the 26-period, and generally this is considered a bullish scenario. During a trending phase, the MACD line generally stays above zero, and that is, as I said, signaling a bullish scenario. So one way to use that would be to have the zero line on your MACD and then use it as a trend direction filter. When the two moving averages separate on your charts, this means when we look at moving average theory, it means that the trend strength is increasing. So as the trend increases in strength, the moving averages will separate, and that also then leads to an increase and a rise of your MACD line. Here you can see the market is accelerating to the downside, the moving averages are separating, and also here you can see the MACD line is falling very quickly. So the degree and the steepness and the slope of the MACD line shows you also the trend strength. When the MACD line is going down or going sideways, it shows you that the trend strength and momentum is down, and you can see here the market is pausing, and that corresponds to here the sideways phase of the MACD line as well. The second component that you will see when you add your MACD is the so-called signal line, and it's the black line here in this case. The signal line is basically a 9-period EMA on the MACD line. So this is actually quite a very interesting approach to have a moving average on the difference of the 12 and the 26 EMA, because it can tell us quite a few things. First of all, it's important to see, is the MACD line above the signal line? Also, is the space between them increasing? Is the MACD line crossing below or above the signal line? And this can tell us quite a few things, as we will see now. When the signal line and the MACD line cross, that's one of the more interesting signals, and it shows you that the momentum of the price action is slowing down or changing. So we're coming here from an uptrend, and in the uptrend, this is the MACD line here in blue, it is going up because the moving averages are separating. The short-term momentum in the 12-period EMA is rising faster than the historical long-term momentum. So the blue line, the blue 12-period EMA is pulling away from the 26 EMA, and that shows us that the momentum is increasing. And you can see here also this is corresponding to a rise of the MACD line, as I just explained a few moments ago. Also, what happens in a very strong uptrend is that the MACD line is pulling away from the signal line. This is because the momentum is increasing short term and very strongly. In a downtrend, you can see that the MACD line is pulling away from the signal line to the downside. So during strong trending markets, you will see that the MACD line and the signal line are separating. That's a very important feature, and when we talk about the MACD histogram in a moment, we will come back to that. So when the two lines cross, what does it mean? It means that the momentum is changing on your charts. So we're going from an uptrend where the momentum is very strong and the price is rising very quickly to then a sideways range and the market is consolidating and there's no more momentum. And that is what the MACD line and the signal line are telling you. The MACD line is now crossing around the signal line and it shows us that momentum is dying down. It's not as strong anymore as it was in the past. Then you can see we're rolling over. The MACD line is trading below the signal line, which is corresponding to a bearish scenario. And you can see the two lines are separating as the bearish trend increases in speed. And then as we enter here the sideways range, the two lines are converging and they're crossing and trading on top of each other again. And there are a few ways how we can use that in our trading, as we will see in a moment. So it's very important that we look at the slope of the MACD line and also of the signal line. The slope is actually very important. Is it rising? Is it rising quicker? Is it rising slower than in the past? And what does this tell us? It tells us a lot about momentum. If the MACD line and the signal line are rising quickly, it shows that the momentum is increasing. Do we see that the MACD line and the signal line are slowing down and the slope is decreasing? It shows us that the price and the trend strength is also slowing down. So it's a very, very important factor. And momentum analysis and trend strength analysis is at the core of every good technical analysis. So the MACD line is a very, very helpful tool, as we will see. And now when we add the histogram, it will become even clearer. The MACD histogram is usually the tool or the component that most traders associate with the MACD. But what is it actually? And the histogram that we see here in the background is nothing but the space between the signal line and the MACD line. So that's why we started with the MACD line. That's why then we added the signal line. And that's why now we're adding also the MACD histogram. The histogram is the space between them. So it's very clear when you can see here the two lines cross, the MACD line and the signal line cross. There is no space between the two lines. So that's when also the histogram is trading at 0. Here as well and here as well. So every time the two lines cross, you also have your cross on the MACD histogram. And then as the space here between the MACD line and the signal line increases, also that's when the MACD histogram is rising or falling in that case. So during a strong trending market, as we have just learned, the two lines will separate, and that's also then corresponding obviously to a rising or falling MACD histogram. When the trend is decreasing in size, the MACD line and also the signal line are coming closer together, and that's then when the MACD histogram is also getting smaller. So essentially, you typically can settle for one or the other. You don't need the histogram if you're using the MACD line or the signal line, because they are basically just showing you the same things. And it comes down to personal preferences. Do you prefer to look at it in terms of the MACD histogram? Then go for that. If you think that the two lines are more helpful and they make more sense to you, then go that. And you don't need to have both on your charts. One very interesting way to use the MACD histogram is to look for divergences. So here we have a clear divergence. As the trend is going down, the price action is making lower highs, right? We have a low here, and a low here. But the MACD line is showing us opposite signals. The MACD histogram peaks are not going down, but they're going up actually. So each peak is showing you less strength. And that is because the price analysis that the MACD is performing in the background is looking at the trend strength, and it seems like that each push to the downside is less and less strong. It corresponds, as we've learned, to the space between the MACD line and the signal line decreasing. So although the trend is still going down, the price is not as strong anymore. And this is something that often when we just would look at a price chart with our eyes without using any indicator, we would miss those important clues. But the indicator is performing a lot of calculations, taking in many more data points than what we usually do when we just look at a naked price chart. And that's where the indicator can actually be very helpful, so that we can spot those things objectively and very quickly. So the indicator would tell us already that the trend is slowing down. And if you are short, it is a good time to think about maybe exiting the trade. We have here a double bottom that is leading here to the second divergence, and then the market is rolling over. The two lines here cross, the signal line and the MACD line, which of course also means that the histogram is now showing us green bars, and then the momentum is increasing to the upside. And you can see the MACD line is now from going down to going up. It's trading above the signal line. It is going up. And that is because the momentum has already changed here on your charts. The two EMAs are coming closer together. Eventually they're crossing and the market is rolling over. So you can see having a MACD can be a very nice addition to your price analysis, and it can help you spot things that you will otherwise overlook. Let's look at the signal sequence when using a MACD and what happens here step by step. First, you will see that the signal line and the MACD line cross, which means that the slope is changing. Also, the space between the two is changing. So we have a change in momentum from bearish to bullish. Second, we have here the blue MACD line cross the zero line. That's very important, as we've learned, because it signals that the two EMAs on our charts are crossing bullish as well. So the MACD line and the signal line crossing, that's our first heads up that we are turning a little bit more bullish. Then the two EMAs crossing is another bullish signal, and that is how you could use it. Point 3 shows you that during the trend, the histogram stays mostly bullish, so mostly green. However, during consolidations that maybe take a little bit longer or go a little bit deeper, there can be short-term changes also in the histogram as well. So that is quite common. It's not always going to be all the way green during a trending market on the histogram. It depends a lot on the strength and the duration of your consolidations. Later you can see the signal line and the MACD line are separating once again. The two moving averages are trading apart from each other. They have never crossed actually, so it's all the way bullish when we just look at the EMAs. Then we get our bearish first signal, which shows us that the histogram is crossing the zero line. It means that the signal line and the MACD line are crossing. It shows us that more bearish momentum is coming into the markets. And then here later you can see the two EMAs are crossing as well, which means that the MACD line is going below zero. So you can see there's a signal sequence usually happening. So here another example, we have the histogram cross as the first signal. So the bullish trend that has been going on is slowing down, and that's your first heads up that the momentum structure is changing. Then you have the EMAs cross. Then we have a divergence here. We have our histogram cross twice. You can see here first time, then second time. After the divergence, that's a very important signal. And then later we have the EMAs cross, which means the signal line is going above zero, and that's your final piece to the puzzle. So you can very nicely follow the trend and the momentum structure from bullish on the left to bearish to more neutral to bullish again. And the MACD line helps you on the way to do that. Let's look at an example where we use the MACD for trend following trading. And here we are looking at a long-term bullish trend. How you could define it is, for example, you go to the higher time frame where you use your higher time frame moving average, and there you would see that the market keeps going up. And in an uptrend, what you usually want to do is you want to look for buying opportunities. And the perfect place to buy is after a consolidation. So you wait for the market to have an impulsive move, then you sit out and you wait for the consolidation to happen. During a consolidation, what you would like to see is that the histogram goes back below zero, and that means that the MACD line is crossing below the signal line. This is your consolidation. And then ideally you would see also a pattern, like here we have a flag, which is probably among the most profitable consolidation patterns. And then what you do is you wait out for everything to turn bullish again. So you want to see breakout out of the pattern. You want to see that the MACD line is crossing above the signal line, and also that then leads to a bullish histogram as well. So here you can see we have that happening. The price action is trading outside of the flag. The MACD and the signal line has crossed, and also here this leads to a bullish histogram. And this shows you that then the consolidation is over, the price is resuming the long-term trend direction, and that can be then the starting point for a trading scenario. And you can see this is what happened afterwards. The histogram stayed bullish all the way. The MACD line was trading above the signal line here, and then as the price action turns, that could be your sign to get out of the trade. So I have a few final thoughts for you at the end of this video. And first of all, the question, do you need the MACD? And I would answer this with yes. And I don't think we have to specifically tie to the MACD, but I have seen that having an indicator can often really enhance the decision making for traders, especially traders who have previously only used naked price analysis. Once they add an indicator and they really understand what the indicator is actually doing, and they spend time looking at the formula, at data analysis, they can really improve their way of looking at charts. Because when we only look at price action and using naked charts, we as traders are not able to pick up the small changes and the small clues that the indicator will often find much quicker. Also, an indicator is a very objective tool, whereas price analysis is very subjective. The indicator is 100% objective, so it's a really good tool to have on your charts. The MACD specifically is also a very helpful tool because it's an all-in-one momentum suite. So as we've seen, it detects and analyzes momentum changes, the speed of momentum as well. It helps us understand the trend confirmation, and with the divergences, we also see when the trend is slowing down. Now, important, is the indicator lagging? And I think that lag is actually a very bad way to look at it, and it's not the right way to look at indicators actually. And what an indicator is actually doing is, it's lagging, it's filtering out short-term chart noise, which is really helpful. You don't want to have your indicator change all the time from bullish to bearish within one candle. You actually want to have the indicator look at a more broader price analysis and look at a more broader chart context. And that is why some traders wrongly, 100% wrongly, believe an indicator is lagging. And what it's actually doing is filtering out noise that you don't want to have in your chart analysis. The MACD is very sensitive to changes, so it's not lagging at all. And that is why I would really recommend to get over the term lagging. Lagging does not exist. It's a wrong word to use. And if traders are throwing around the term lagging, it just shows you that they have not understood what an indicator is and how to use it in the correct way. So I hope this video helps you in a way or another to help you look at the MACD in different ways, to help you understand how to use indicators, and maybe you get some ideas on how to implement it in your own trading.